So that brings us to the next subject, and this is qualifying longevity annuity contracts. This is something that's brand spanking new for you that you are going to be allowed to take advantage of, not only in 2014, but this is something that you'll be able to take advantage of if you so desire going off into the future. And what it is earlier this year, the United States Treasury, they issued a Treasury decision, and they allowed participants in IRAs, 401ks, 403bs, and 457 plans to enter into what are called qualifying longevity annuity contracts. And what this is this is a type of deferred income annuity. So what happens in these types of contracts is that they are allowed to invest the lesser of 25% of their account balance at the time of purchase, or $125,000, whatever's lesser, into some type of annuity contract that begins at an advanced age and will not count towards the participant's required minimum distribution balance. So this means that if you're taking required minimum distributions from your IRAs, 401ks, 403b plans, you're taking these and you're going, you know, I don't really need all of this money. Well, then, by having one of these qualifying longevity annuity contracts, this would reduce the amount of your minimum distribution. So the way that these work is that the owner of the retirement account no longer is required to include the value of this type of annuity in the value of their IRA, 401k, or 403b plan. So they don't have to include this when they're computing their required minimum distribution. So what this does is this is going to allow the owner to defer payments from the qualifying annuity up until their age 85. So think about this. You're age 70, you can put $125,000 away that you don't have to start taking payments on until you're age 85. That allows 15 years of extra tax deferral. And again, if you are in one of those higher tax brackets, again, we like the idea of pushing taxes out towards the future. So benefits are going to be allowed to be paid after the death of the participant to their beneficiary. And then at the death of the owner, a plan with a qualifying longevity annuity contract, what they can do is they can protect their investment by providing an option that allows for a lump sum payout of any unused premium. And then there's a contract purchased by a retirement plan that must specify that is the intention of the annuity to qualify as a qualifying long-term annuity contract. So you need to make sure that that the contract itself qualifies for this type of annuity. So let's take a look at how this works in terms of an example. Here we've got John. And John is age 70. He has a balance of $650,000 in his IRA. And so what John does is he purchases a qualifying long-term annuity contract, longevity annuity contract, in the amount of $125,000. That's the most he can put in. And what he does is this reduces the balance that's required for his required minimum distribution. It reduces that to $525,000. So by doing this, this reduces his required minimum distribution for 2015 by over $4,500. So it's not just for 2015, but this is going to be for 2016, 17, 18, all the way until he's age 85. So if John has chosen to defer a payment from his QLAC contract until age 85, he now has allowed his retirement assets to grow by approximately $50,000, and he's deferred taxation of over $70,000, providing additional funds for either late life expense or his heirs. So again, this is something, again, that might be a very good deal for people who do not need to take they take a look at their required minimum distribution from their IRA and they go, I don't need all of this money. Having one of these types of annuity contracts might be a solution for someone like that.